What are marketable securities? Have you ever wondered what marketable securities are and how they fit into financial statements? Let's break it down in a straightforward way. Marketable securities are short-term financial instruments that can be quickly turned into cash, usually within a year or even as fast as 90 days. They are traded on public exchanges, which means they can be sold easily without losing much value. This liquidity makes them similar to cash, which is why they are often classified as cash-like assets. On a balance sheet prepared according to generally accepted accounting principles, or GAAP, marketable securities are listed as current assets. This classification is important because it shows that these assets can be converted into cash quickly, helping businesses manage their day-to-day operations. Marketable securities can be grouped into two main types. First, we have marketable equity securities. These include common stocks and preferred stocks of companies that are publicly traded. You can sell these stocks on stock exchanges like the New York Stock Exchange or NASDAQ without much hassle. The second type is marketable debt securities. These include government-issued debt instruments such as treasury bills and commercial paper. These securities usually have short maturities and are issued to raise funds for various activities, whether by businesses or governments. When it comes to accounting, marketable securities are reported at their fair market value on the balance sheet. Since their prices can change, companies may need to adjust their value to reflected current market conditions. This means they might recognize unrealized gains or losses based on how the securities are classified, whether as trading or available for sale. From a tax standpoint, any gains or losses from selling marketable securities are recognized in the period when the sale happens. The length of time you hold these securities affects how they are taxed. If you hold them for a short time, gains are often taxed as ordinary income, which can be at a higher rate. In practical terms, companies use marketable securities to improve their liquidity. This means they can quickly access cash to meet short-term obligations. Additionally, these securities can provide a return on excess cash without sacrificing liquidity, often yielding more than traditional bank deposits. They also help in managing risk by diversifying investments into low-risk, short-term instruments. In summary, marketable securities play a vital role in a company's financial health. They provide liquidity, flexibility, and the potential for modest returns. Their accounting treatment is based on fair market value, and tax implications depend on how long they are held. Understanding marketable securities is essential for anyone looking to grasp financial statements and the principles of GAAP.